Hi, this is Eric Schleien, and you are listening to the Intelligent Investing Podcast, where I discuss value investing, rational analysis, and break down the processes, principles, and mental models of business owners and managers. Today's episode is brought to you by ticker.com, TIKR.com, which is focused on bringing institutional quality investment research tools to the individual investor. Ticker.com is powered by S&P Global Capital IQ and has coverage of 50,000 plus stocks globally with financials, estimates, valuation metrics, ownership transcripts, news filings, and more. This is a product I use personally, and I'm always happy to sponsor products, things I personally use or can put my name behind. So join ticker.com's free trial today with tikr.com/intelligence. This podcast is also sponsored by Podbean, which is the host that I use for this show. Podbean is probably the easiest way to create your own podcast. And we do use Podbean to host the Intelligent Investing Podcast. And also another podcast that I host as well, the Eric Schleien Show, which you can download the free Podbean podcast app. And you can do it really easily. You just start, record, and publish your very own podcast in minutes. And they work great with me when I was setting this up years ago. Podbean does provide everything you need to run your podcast, and you can record and publish episodes directly from the app onto your phone. That's Podbean, Podbean podcast app. Check it out. Now, today we have a very special guest who is local to me. He is based in Austin, Texas. His name is Ben Kogut, and he has been involved in commercial real estate since 2005. And for about the past 5 years, he's been a partner in a mid-sized syndication firm, and they specialize in acquiring retail, medical, and industrial properties. He raised over $110 million dollars in those last 5 years as well. And then in July 2023, started a new company, Rooster Equity, which is focused on raising private equity capital for commercial real estate assets. And he also is a co-host for another awesome podcast, which also happens to be the number one podcast on real estate syndication. And I've been an honored guest on that show as well before I even knew Ben. Personally, he's also he's very proud of his leadership in the Jewish community on a national level. He's also very big in the Jewish community here out in Austin. He's passionate about traveling the world, being outdoors with his golden doodle Mazzy, who I've had also the pleasure of meeting before, into music, dancing, pickleball, and cooking with friends. And without further ado, Ben, welcome to the show.
Eric, honored to be here. Thanks for that wonderful intro and excited to get into it with you, brother.
Yeah, for sure. So tell me a little bit about, before we even get into Rooster Equity, one of the things I like about you and wanted to have you on the show is you have a value investing mindset, and your specialty is in real estate, which you don't see as often. How did you get into real estate? What sort of shaped your philosophy? Because for every one of you, I mean, 1,000 others who I would never in a million years bring onto this show. So just curious how you got started in all of this.
Yeah, great question. Thanks. Yeah, I after graduating from UT in 2004, I had some mentors who brought me under their wings. So I really give a lot of credit. Jason Mittman, Jeff Newberg, these are some real estate legends who I was blessed to be introduced to at a young age and really learned that it's better to copy genius than create mediocrity. So I shadowed them and did everything I could from starting at sweeping the floors and just worked my way up over the last 20 years and found a passion for commercial real estate investing. And that's really what I've been focused on for the last 20 years, basically my entire career.
And tell us a little bit more about what you were doing for the last 5 years, or really those years before starting Rooster.
Yeah, sure. So I wanted to get out of the brokerage business. I had been doing that for about 12 years. And back in 2017, I had made some money and wanted to invest it. So I invested in my first syndication at the age of, oh, I don't know what age it was, but it was 2017. And from there, it was this mid-sized company that I mentioned based in Wichita, Kansas. And the CEO had basically made me an offer I couldn't refuse to join the company as a partner and help him with investor relations, raising capital, and all the fun things that come with making presentations and schmoozing and all that kind of stuff. Yeah, he gave me a shot at raising some capital, and what I do, I went to the people I knew. I went to my network and I said, "Hey, here's this great deal. Here's this great team." I did my due diligence as best I could. And yeah, lo and behold, people started investing in these projects. We were looking at syndication, which is crowdfunding, usually 50 or 100, $150,000 investments into triple net properties. And I already knew a lot about triple net properties because I was brokering them. And in this case, I thought, hey, I think, there's a lot of people that want to have this type of investment in their portfolio for a lot of benefits, the passive income, the depreciation, aka tax benefits, the appreciation over time as the value of the property goes up, and so on and so forth. And so I was basically just teaching. I was just really taking a teaching approach. I teach people about investing in commercial real estate syndications and it- just be myself and have fun. And you let people poke holes in as best they can and just try to be transparent and lead with an educational mindset as opposed to trying to sell people on something. And I think people appreciate that about how I approach this. And yeah, so over the last 5 years, did 40 something syndication projects, raised over $110 million from a couple hundred people. And it's been a good run. And yeah, really grateful to my partner for bringing me into all those projects. And it's really changed my life. And I've learned a lot. And then I decided it's time to go and start my own company. And so I started Rooster Equity. Rooster because my last name is Kogut, and Kogut is Polish. It means rooster in Polish. And so that'd be a fun way to differentiate the name of my company. And so, yeah, now I took all the lessons I've learned throughout my career and continue to help people and invest in great commercial real estate, risk adjusted projects and having a ton of fun.
Now, you had mentioned doing some stuff with triple net lease properties. What's would you say you had quite a number of successes in that area?
Yeah, thank goodness. We have had a lot of success buying shopping centers, medical buildings, industrial buildings, some quick service restaurants. And what I find is that there's a lot of misunderstanding about, let's say retail as an example.
Sure.
Some people will say, "Oh, retail is dead, Amazon and the internet, this and that." Retail's not dead, it's just change. Here in Austin, as an example, the retail commercial real estate is 97% occupied. There's very little vacancy. And so why is that? It's because these shopping centers, and I'm not talking about big malls. That's a different animal. I'm talking about the strip centers and the grocery anchored shopping centers and just like your mom and pop where you have your nail salons and you have the restaurants and you have dentists and you have it's all these different things. And so the space is not necessarily where you go shopping, but it's where you go to get your everyday needs taken care of. And
Yeah.
even during the pandemic when things were shut down, and there was a scary moment with retail with all that, but to be honest, it's been the strongest asset class that we've had and continues to be that way.
Now, when you're looking at, say, with a triple net lease property, what are you actually looking for to deem that something that's going to be a good investment over time? And then the reason I ask is that if you were just to go on real estate listings today, most of these triple net lease properties, that yield, that cash flow yield is barely covering your interest payments on financing. I can look today and look at things that are five caps, six caps, seven caps seems to be even on the higher end. And when you have interest rates, you know, pretty much the same as that, and what you could borrow money at might even be higher than that. How are people to make money? How are you making money on this? What should investors look for looking at triple net lease properties?
Yeah, great question, Eric. I would say first and foremost, the unit economics of the tenant or tenants that occupy the space. So we look closely at how many widgets does that tenant need to sell in order to be able to break even, and then take that even further to find out to what extent do they need to be profitable to be able to afford the rent? How do those rents in this space compare to the market? Triple nets, also, how much are the triple nets? Although those are hard to really adjust. So that's really what we're looking at first, the credit of the tenant, their unit economics, the terms of the lease, how long is that lease term? And then we use some AI techniques. There's a tool that allows us to use and track cell phone data. So
Okay.
in retail, it's really important to know how many people are visiting those locations. And so we all inherently know that we're being tracked by our phones, whether we like it or not.
Sure.
And so there is data out there that tells us, let's say, I don't know, a Walgreens or some sort of QSR or restaurant, McDonald's. And so what we can do is we can find out on a daily basis how many people are visiting these locations. And then from that data, we can determine how does that location compare to the other units. We'll use Walgreens as an example.
Sure.
Is this in the top tier of Walgreens, the bottom tier, somewhere in between? Because if it's in the bottom tier, then that's gonna raise a red flag. We're gonna want to know, okay, why? How is this location? Are they about to shut this thing down? So on and so forth. So it gives us some data that we can use to determine whether or not this location is going to be viable. So there's a lot of the old location is outdated. There's a whole lot more questions to be asking when digging into these commercial real estate leases. And to your point, cap rates are compressed, and sometimes they're usually lower than where we're at with interest rates. So how do we make sense of that? Before the last 5 years before interest rates shot up, there was quite the gap between the cap rates that we were able to acquire at and take positive leverage with super low interest rates. And so that was good times for us for sure to be able to find positive, like massively positive leverage. And so that's one thought. And then I'll share we have a strategy where we know what we're looking for, and we basically look at a massive amount of deals on a monthly basis. And so we use AI and we use different techniques to try to what we're looking for is motivation. We're looking for a seller who is in distress, typically for reasons that are outside of the property. So think a death in the family or an inheritance or a divorce, all those typical
Sure.
motivating factors. And so we'll be very quick to make an offer. Usually I don't love this term, but I'll use it anyways. They're lowball offers. And so we're looking to uncover value
Yep.
and
Well, and you're
main
providing them value with that speed of closing a transaction.
correct. Correct. Yeah. And to be honest, we find that we're usually the first offer they get. So we're constantly monitoring the market to see what's hitting across the country, more focused on the red states than blue right now.
Why is
And
that? That's interesting.
it's there's just a lot more bureaucracy and red tape and oftentimes
Okay.
taxes. When you buy real estate in a state that has state income tax, the CPAs have to take it a step further. There's more paperwork involved in that. And so there's enough deals to go around in the red states that we're happy with that. And being
Well,
that we're here in Texas, there's a lot of opportunity here as well.
sure.
Yeah, so I'll share with you like a technique that we use to uncover value in, let's say we look at 1,000 to 1,500 deals a month.
We'll stop
I'd
right there for
say
a second. I'm first curious, when you say, okay, I'll look at, you said 15,000 or 1,500?
100.
Okay. So 1,500 deals in a month. How are you sourcing those deals, and how do you have time to look through 1,500 specific deals just in the triple net lease space? A
We,
two-part
have
question, really. Yeah.
yeah, have all the tools to get on all the listing websites. We have access to all the major brokerage houses, and we're just constantly looking. Now, a lot of that, I'd say 90% of it, 80, 90% of it is not going to fit our box. So we can just sift right past that.
Sure.
The things that do fit in our box, we're going to dig in, and if it comes on, usually within 24 hours of it hitting the market, we're going to make an offer. And
Okay.
then with that offer, we're going to preemptively send a list of references. We're going to typically we send a PSA, purchase and sale agreement, as opposed to sending a letter of intent, showing that we're serious about moving forward. And then we typically, depending on where it's at, but typically we're promising the seller that within 2 weeks of being under contract, we're going to personally, physically be on site of that property. So it requires a lot of travel
Yep.
and moving quick, but that's really how we've been able to buy and steal a lot of real estate, being first there, first to make the offer, and being aggressive. Now we're almost never the top price, hardly ever, probably
Yeah.
never, but they're motivated. So that's not necessarily what, they're trying to achieve. They're trying to make the deal happen and move on. And so that's been one of the secrets to our success is making it happen in that way.
Interesting. And then what other kinds of asset classes in the sphere of real estate would you say you specialize in or that you see opportunity in?
Right now, we are looking at office, and
Interesting.
I
And
know
people hate office, right? That's the general consensus
yes.
is
What's Buffett's quote? When
be fearful when others are greedy and be greedy when others are fearful.
Thank you. That's exactly what I was looking
I got
for.
you.
And okay, so let's not throw office out with everything. So what we're looking at in particular is medical office
Okay.
and government leased office.
Hmm.
And so let's talk
When you
about
say government
government.
leased office, are you talking about like government institutions, bureaucracies that have office space?
Yes, a courthouse
Mm.
or the IRS or a defense department or specialty. So we have a building that we have these types of tenants. And one of the great things about these tenants is that their credit is fantastic. One of the bad things about doing a deal with the government lease is that they typically have outs. They can terminate the lease with regularity because the government shifts its mentality and its regulations on a regular basis. So we have found a way to mitigate that risk. So what do we do is in our due diligence phase, we hire a third party lobbyist, somebody that's impartial to the deal, somebody that has the government relationships already in place. They can go in and find out, okay, what are the people that decide these things at the government? What are their intentions? Are they going to move this location? What would it take to move this location? That courthouse I just mentioned, they are required by law to send out a snail mail notification if and when they make a relocation. If they do that, it's going to cost darn near $1 million in postage if they decide to make a move when their rent is a massive fraction of that. And are they going to move? Highly unlikely. And
Hmm.
so they've been there a long time. They just spent a massive amount of money renovating the space. There's pretty much nowhere else they could go for lower rent. And although there is risk in them shutting it down, the termination clause, based on our due diligence and research and utilizing the relationships that the lobbyist has, we've concluded that they're not going anywhere. And when you couple that with the fact that we're buying it for an 11 cap,
Yeah, that's pretty good.
we can justify that risk.
And are you finding that office regarding government is basically just all trading at the same kind of high cap rates as and medical as well? Are you finding all just kind of high cap rate stuff or
Yes,
like people are throwing the baby out with the bathwater?
medical's a little bit less. I wouldn't
It's
say that
okay.
it's quite 10 cap plus yet. But yeah, that we're value investors. We're looking for yield and government. And so government related, I'll give you an example. We
Well, when you say
bought
hold on,
a
sorry, when you say you're looking for yield, what sort of overall investment return are you is your do you have an internal hurdle that like I want to make X% a year?
it's we still have to wear the entrepreneurial hat and figure out, okay, what's risk adjusted. I don't like to have just we have to have this hurdle. Otherwise, we're not going to do the deal because I think that for my investors, they want a diversified portfolio. So we could get into something with maybe a little less risk, aka lower cap rate, and some deals have a higher cap, and somewhere in between. So it varies. So I try to avoid any kind of hard and fast rules about what kind of returns we're looking for.
Got it. Okay.
Yeah. And I'll just kind of give you a couple more examples. We bought
Sure.
a $20 million office building that has one tenant. It's a Jacobs Engineering building. And Jacobs Engineering, they're a multi-billion dollar publicly traded company. They're one of the biggest third-party companies that handle engineering on behalf of NASA. And so they're located at the gate of NASA in Houston. And we asked ourselves, okay, if they're in charge of all the engineering, they do it in their building, not all of it. So they have a certain niche. Do we think that NASA is going to shut down anytime soon? And the obvious answer is no. Do we think that this particular program, it's based on Artemis, which is the NASA's intention to go to the moon? We don't see that going anywhere anytime soon as well. And the tenant isn't the government, but they are a massive government contractor. We could buy that for better than a 10 cap and cash flow that and find debt with positive leverage on something like that. So just to give you a couple of examples.
And say you're borrowing money against that, how are you structuring that debt?
That was a few years ago, so that has
Okay.
changed. But there is still debt. LTVs and the rates are not as favorable as they used to be, but we can still make sense of it when you buy into a 10 cap plus deal.
So say you find a 10 cap today, that's say a medical office property. What kind of debt structure I assume you have something general in mind going into that, putting out a purchase agreement. Right? You have some sense of what terms you're going to get. What are you looking for in today's environment?
Looking for and expecting, I would say we're looking for somewhere in the 70 something percent LTV. We're expecting probably somewhere in the 60 to 65% LTV.
Okay.
Rates are in the upper sixes, mid sevens, as far as interest rates are concerned. I'd say that those are generally where we're at right now. I
Okay.
think a lot of people are waiting around for rates to come back down. Not seeing it. And so I'm not going to bank on that.
So are
But
your PSAs that you're putting in taking into account, again, not what you're wanting, but what you're expecting? And you've done some stuff with sale leasebacks, right?
yes.
Tell us a little bit about that.
Yes, this is a
Also, for listeners who don't know what that is, can you explain what that is as well?
yeah, sure. So we partnered with some tenants who are expanding and they want our help in acquiring the real estate. And I'll give a couple examples. So we work with a medical group that wants to, let's say, let's get an urgent care facility. They want to occupy an urgent care facility. And so we would partner with them. They would basically put the property under contract and then flip the contract to us for a profit. Let's say it's a $1.5 million building and they will flip it to us for $2 million. So they'll take that $500,000 and they use that for their tenant improvement allowance, for working capital, for branding and marketing, for equipment, or whatever it happens to be. And then at that $2 million valuation, they sign a lease, well, basically back into, okay, how much is the rent going to have to be in order to achieve the cap rate that we mutually agree upon? It used to be that cap rate would be somewhere in the 8.5 cap range. That's gone up now, probably in the nines. But that gives us, they'll sign a long-term lease. So in other words, they're selling it to us and then leasing it back. So they're happy being a tenant. They're going to pay all the triple nets. They're going to pay all the maintenance expenses. But this is a way for them to it's creative financing where instead of getting a loan, they would basically amortize it into the lease throughout the next 20 years. And it gives us a yield. And then at some point, if we want to sell it, if we have a 20-year triple net lease, maybe 5 years into the deal with 15 years on the lease, we can sell it. We were into it for a 9 cap, and these things sell probably in the 6s or 7 cap range. And then we take that spread, we pay back. We're giving our investors a return the whole time. But then at that point, once we exit, we give all our investors a nice profit bump on top of what they put into it and move on to the next deal.
Yeah. What do you specifically like about the sale leaseback category?
I like that in general, our interests are aligned. We're occupying space. for a long term is very much in line with what we're trying to achieve. Great question. A sale leaseback. Here's a quote that I also is that it's better to buy and negotiate it and then sell at auction. And
Mhm.
so we can negotiate terms that work for all of us and typically get more favorable terms in that way. We can scale it. We've made this more of a programmatic deal where we can do this over and over again. So I'm going to share with you about a car wash deal
Okay.
where we partnered with a car wash. They are a massive car wash chain out of Colorado, and they are looking to expand. And so in order to expand, it costs about $5 million to build a car wash facility. 3 million of that capital stack is debt. They sign on the debt. Then the next 2 million is where we come in with 1 million. They come in with 1 million to get the deal done, but they give us a 12% preferred return on our money. And then they pay rent to the us as a landlord. And then first money goes to pay the debt. And then the second money goes to pay the investors, us, 12% on our money. And then after that, the cash flow that remains, we split 50-50 with us and them as a partner in the real estate. And so that is us holding hands with the tenant where our interests are very much aligned. And yeah, that's been another strategy that's worked well for us.
Interesting. Where do you I'm sorry, this? You say you turn over a lot of stones. It seems like you're looking at a lot of stuff. What's maybe some quirky things that you've found over the years, something a little bit more unusual or different? Do you have any interesting stories?
Sure, I'll share with you about 27 double wides that we
Okay.
acquired in South Carolina.
Say more.
Yeah, this is gonna be interesting. Okay, I had a condo here in Austin that I sold, and I wanted to 1031 the proceeds. And so a friend of mine based in South Carolina had a contract to acquire the notes on 27 double wides. So here's where it gets quirky. So this guy had been buying up pieces of land, not contiguous, just random cheap pieces of land around South Carolina, and he was selling them with seller financing. And so people would buy the land, they'd put a double wide on the property, and then he would seller finance it to them with a small amount down, and people would start making payments. And so he had put together a portfolio of about 27 of these. And so my friend had a contract to buy all 27 for, I want to say $1.7 million. And so with this guy, since he's a seller financer, we got him to seller finance that 1.7 million to us. And so I exchanged the cash from the sale of the condo here in Austin. I want to say it was around $350,000 or something like that. And we used that in our partnership as the down payment to the gentleman. And that meant that I think 4 or 5 of the lots out of the 27 were now free and clear and unencumbered.
Mhm.
And then he financed the remaining lots such that we were not going to pay him monthly. We were going to pay him lump sum payments once a year for the next, I want to say 6 years, maybe 5 years, 5 years. So in other words, we're paying him 200, I think it came out to like $280,000 once, on an annual basis. And so the cash flow from the payments from the people occupying the double wides was more than enough to cover our annual lump sum payment. And now is where it's going to get really interesting.
Okay.
So now that we had 4 free and clear notes on lots, we wanted to trade them. So we traded, here's, see if you can follow along. This lady had a piece of land worth $400,000. Okay.
Mm.
So she was willing to take 4 of the lots as a down payment.
Okay.
Let's just round some numbers. Let's say that was worth $200,000.
Yep.
And then she seller financed the other 200,000. So we're into this for 4 lots in financing. And then we took that $400,000 piece of land and immediately sold it. So now we have about $400,000 coming into the partnership. Fast forward, we went to the gentleman who we owed $280,000 to. I think this was in October or November, purposefully doing it before the Christmas timeframe. And we go to him. We owe him in, I think, March or April.
Okay.
So we go to him like 5, 6 months in advance, and we say, "Hey, we owe you $280,000 6 months from now. Would you be willing to take a discount if we paid all of that now?" And so, long story short, he took a massive discount. He decided that he wanted that money now. And so we did the deal. And the lady who seller financed us agreed. So we were paying her, I can't remember what it was, but like $1,500 a month on that $200,000 that she financed us. Turns out it was 0% interest. She really just agreed. She was just happy taking a monthly payment. And
Cool.
we asked her, "Hey, are you okay if we just don't pay you off and we just keep paying you this monthly payment?" And she was happy. Yeah, she's like, "Yeah, just keep paying me that monthly payment and we're good." So that was one way that we've been able to creatively finance deals. I think our effective interest rate is probably less than 1% when you do these types of techniques.
That's wild.
And that's the gist of it. You got it. But we've actually done that several times where,
What kind of investment return did you get on that?
man, it gets even more interesting
Okay.
because a part of my investment was my 1031. And then another part of my investment was my self-directed Roth IRA. That's
Oh,
also a partner in the deal.
how
And
interesting.
so I structured the deal so that the partnership would pay a portion of it to me and a portion of it to my Roth IRA. And I think we were uh, underwriting it to be about like a 12% cash on cash return. I think it's since been like 22 or 23% cash on cash.
So you were off by just a little.
Of which a bulk of that is going to the self-directed Roth.
That's great. And then, of course, there's additional benefits from it going into an IRA account as well.
Yeah, exactly. Yeah. So that IRA account is ballooning faster. So now I'm taking that and I invested a bulk of that into some more projects. I actually invested it into an Israel VC fund focused on Israeli startups.
Oh, that's cool. Well, we both have investments in Israel.
Absolutely.
Yeah.
Absolutely.
I own a
So
little bit of the Tel Aviv Stock Exchange.
nice. How's that going for you?
It's doing okay.
Yeah, I think that since the war started, I think a lot of investors have been scared to invest in Israel. So again, it's that mentality that when people are scared to go into these markets, but the truth of the
Yeah.
matter is, I was in Israel a few months ago. The people are resilient, and it doesn't like what on the ground there is not like on TV. There is still a lot of talented people who did go back to serve in the military, but it's doesn't mean that these companies, they're still on solid ground. There's still so much opportunity. And just because a lot of investment dollars dried up, honestly, man, I think that would be another area where I'd be looking really closely
Yeah.
right now.
I'm going to be generalizing here, but I think there's probably something to it. When you are investing in things that involve people, and those people happen to all be either in the military or have been in the military, I think net overall, you're going to get a higher quality individual, higher character, more discipline, more integrity, all of those things. It's a little bit like when Geico, this is a little side tangent, but when Geico started, when they started Geico, the competitive advantage, are you familiar with the history of Geico?
I know that this is a Buffett. Maybe is this a Buffett related conversation
No,
or?
no, this is before Buffett was involved or anything. But when they first started insuring people, it was government employees and teachers. And the whole thesis was if you're somebody who works for the government and is honorable enough to work for the government, which is, I think, a little laughable in today's age, but back then, that you're honorable enough to work for the government, or you want to be, or you're a teacher, um, they're going to be less likely to get into car accidents. They're going to follow the speed limit better. And there was no data analytics back then. It's not to the level that there is now. And it worked. And that was a big competitive advantage when Geico first started. Same kind of deal, I think, if you are investing in Israeli startups or Israeli businesses or Israeli developers. I think there are certain populations in the world where I'm very bullish on Israel. I'm also very bullish generally on Indians, like the Indian population, and also the Chinese. I think that the work ethic there is incredible. And just like Israel in different ways, what you hear about, right? India, the bad stuff you hear about, media always likes to talk about the bad stuff, right? The bad stuff you hear about India is all the corruption. The bad stuff you hear about China, there's a million things you can name. But I think people are going to be surprised over the next few decades when they see some of these populations getting very, very influential all around the world. And I put Israel in there too. I think the Israeli people are extremely resilient, and it's incredible what a little country has been able to do.
Amen to that. Did you read the book Startup Nation?
Mm-hmm. It did.
Yeah. And so one of the big takeaways I recall from that was in the Israeli military, it's encouraged to from the bottom up type of decision making as opposed to top down. And so that trickles into a lot of these wonderful startups that have had tremendous success. And so I think that mentality and, like you said, that work ethic and all that comes with that is very evident, especially if you go visit there and see it for yourself.
Yeah. What's not in that book, and there's a lot of data to support this, is when you're able to build environments that people have the freedom to do more independent thinking. And of course, it comes with the boundary, right? That there's still alignment on certain missions or values or whatever, because you can decentralize things and people aren't actually aligned. It could not be good. But assuming the alignment's there and you decentralize those processes, the average profits tend to go up. Actually, average productivity. So in a for-profit or profits, if you're a nonprofit, it could be fundraising, but output goes up by a factor of, on the low end, 300%. And it's usually 3 to 5x. So it all plays into each other. Yeah.
Real quick, I want to maybe flip a question back at you. We've mentioned Buffett a couple of times, and I know you're a disciple and headed out to the motherland here. I don't remember exactly what it is, but I know it's soon. And
Yeah.
I'm curious what you're thinking or what you're anticipating will be occurring at the Berkshire meeting this year.
Yeah. See, even though I've been on his podcast before he was hosting, and it's like now I'm getting asked questions from the host again. Say that again.
I'm just curious, what are you anticipating? And I know you've been many times. I'd love to know what have you learned over the years in general? How has it changed? And what maybe you might be anticipating will be the general sentiment when you go to the meeting this year?
Okay, I missed the third part. Okay, I guess that was three questions in one. So the first one is, say the first part again. I'm bad when
Just historically, what have you noticed by
okay, what have I
you
learned?
and my buddy Adam Blum, you are the two people I know that have gone to it so many times. I've thought about going, I never have, but I'm wondering, like, why do you keep going?
Do I know Adam Blum?
He's a genius. You should
What is
talk to
he?
him.
What's his company? Is he in Austin?
Yeah, he's here in Austin.
Private investment vehicle, LinkedIn, is it?
Yes.
Can you introduce us? I don't even know this guy.
Oh yeah, of course. Yeah.
Is he Jewish? I've probably known other Adam Blums, but it's not this Adam Blum.
He is a genius like yourself.
I don't know, but I'm not a genius, but I'm good at what I would call like idea synthesis. So I have a knack to take different ideas and principles from different seemingly unrelated walks of life and see how they relate and connect. That's really what my strength is. Albert Einstein was a genius. I've known people who are geniuses. I'm not a genius, but I'm good at making connections. Thank you.
you should, I'll try to introduce you guys prior to you going out there so that
I would love that. Yeah, I would love that. So yeah, my experience historically has been there's lots of really incredible people. So when you say, "Oh, I have a friend, he's amazing," he goes to Berkshire. Generally, that's the type that goes to Berkshire many times in a row. What I've learned, it's less so what I've learned. Like I can't necessarily say there's this thing or that thing I learned, but it reinforces this conversation. And before this was live streamed on, I think Yahoo Finance does it. The only way you could actually see the meeting was to go. So for me, it was almost a somewhat like religious experience of being in that conversation, maybe see things I could be doing in my personal life or my business with more integrity, ways I could structure contracts to make them more aligned with my partners. It's such an ethical Buffett and Munger, the way they've run Berkshire or Munger ran Berkshire over those many years. It's incredible how far above and beyond ethically they do business. I remember one year when they were talking about buying back stock and they ended up changing the policy, thank God on this. But I disagreed with them, but I understood where they were coming from. And this was one of the only quote unquote ethical decisions that I personally found unethical, but I could see why they were doing it. And but this is how far they take ethics is, let's put it this way. The fact that my biggest ethical complaint about something was they were so ethical that I found it was hurting someone else by accident. That's like a great problem set to have, right? So they had this policy that if they were to buy back stock, if it was cheap, they would file a press release saying that they thought the stock was cheap, that they don't think that you should sell it, but they're looking to buy back stock. Now, of course, if Buffett goes, I think the stock is cheap, I want to buy back stock, the stock's just going to pop up and they lose the opportunity to buy back stock. And if you're a current shareholder, you've been harmed by that. Now, the argument Buffett would make at the time is he would say, if we want to buy back stock, that means some of our partners are going to sell to us. And we want to make sure that our partners know that we don't think that they're getting a good deal so they can make that decision. And one principle they have at Berkshire is that if you own one share or if you're on the board of directors, you're treated like a partner. You're treated the same, which I love. But in that sense, they missed some buyback opportunities over the years. Now they don't announce it. Now they just buy back and that's worked nicely at opportune times. But yeah, it's really reinforced this business ethos that you don't really experience outside the Berkshire Hathaway culture. There are companies who've copied it in their own way. There's an insurer based out of Richmond, Virginia called Markel Corporation, which, just disclosure, I do own some shares. But Tom Gaynor, who is the investment manager there and also one of the CEOs, he was a big lover of Berkshire and he wasn't the one that convinced it, but Markel was very early influenced by Berkshire going back, I think, to the late 80s, and it completely transformed that business. But the reinforcement is the big thing. How I've found it is today is different. I don't technically need to go there to see the meeting because it's live stream. So 90% of why I'm going there is for the people, because I can't remember the last time I've actually attended 100% of the entire meeting, because I just know I can just watch it online when I'm home or on my drive back home. Usually I'll listen to it. 6-7 hour recording. But the one thing I will say is, I noticed this maybe 5 or 6 years ago, the quality of the people are not the same as it was when I first started going 18 years ago. And I just remember being 18, 19 years old, and I would be in the same room with Bill Ackman and a bunch of these several billionaires in a small private party of 100 people or something. You don't see that as much anymore. And it's a lot of younger people, a lot of people that it's their first time, second time going. I hardly recognize anybody anymore when I attend these, where it used to be I would know 20, 30 people in a room easily, and they would know me. And it was great.
Yeah.
Um, and my kind of what I'm expecting this year, I'm expecting there's going to be serendipitous things that happen. That's always the most fun stuff, but you don't know what that's going to be. But when you're in an environment with thousands of people and we're all there for similar reasons, there's just going to be interesting serendipitous relationships that happen. And over many years, it's pretty cool how some of those relationships evolve and what comes out of it. So who the hell knows what that looks like? But that's always one of the exciting things for me. And then this is going to be the first year without Charlie Munger. He passed right before his 100th birthday. He had I'll put a link to it actually in the show notes. He did an interview for CNBC like 2 weeks before he passed. And it was a really good interview too. Like one of the best ones he's ever done. You wouldn't have known he was going to die. And he seemed fine. He seemed sharp. So I'm going to imagine there's going to be something related to Charlie this
Tributes.
year. Yeah. So it's going to be a little weird not having him up on the stage because he's hilarious. I don't know if you've ever seen clips of him and Buffett together.
Oh
So
yeah.
funny. So I'm going to
Yeah.
miss that. Yeah.
A
That's
great
one
duo. And I think
that
Warren is 93 now.
is up there.
God bless
Yeah.
him.
Yeah. Do you have any interest in coming sometime?
I would say so. It feels like Burning Man had like their OG people, and then like a bunch of other people now go to Burning Man. All the OGs are like, oh, it's not the same. It's that.
Yeah. It's great though. It's our own little cult and our cult leader's in his 90s and we listen to him talk and yeah, it's a cool experience, even if you just do it once.
Yeah. Interested. Don't think I can make it this year, but we'll definitely eagerly await
Yeah.
your summary and all the great stuff that you learn along the way.
And so I want to direct it back to you since you are the
Okay,
guest of
fast.
the show. Um, what do you, for the person listening, there's going to be a good chunk of people who hear what you do and say, oh, I don't know how to have access to all these listings and look at 1,500 properties a month. And there's a lot that goes into that. I know you have a lot of relationships in the industry, but for someone listening who is a value investor, manages their own capital, says, how can I apply this to my own investment portfolio? They have $1 million in cash lying around and they want to do this themselves. What kind of advice do you give to someone like that?
I'd be remiss to say we work with accredited investors. They invest in deals. They reach out to me through my website,
Well, let's say
rooster.
they don't want to invest in a syndicate deal or the like that Rooster guy sounds interesting, but fuck him, I want to do it myself. Right. For someone with that attitude, they don't want to invest in anyone else. They just want to do it themselves. They don't want to pay fees to anybody. What's your advice to someone like that?
I would say find your niche, and ours being triple net. Let's just focus on that. Let's say you said, you know what? I like this idea of triple net investing. I like that the tenant is going to pay for all the taxes, insurance, and maintenance costs. And so I need to underwrite who the tenant is. I would say find your risk tolerance. Where do you fall on that? Do you want a tenant that is high credit? Are you okay with something with more of a less credit tenant? That kind of thing. So that's a personal question for an investor.
So question there, and I think I have a pretty good read on my audience. So the natural question would be, let's say the tenant isn't so good. Okay. Maybe they're, I don't know, like a mom and pop nail salon or something, right? Which you don't know if that's going to be there in 5 years. It might, but it may not be. How easy is it typically to refill that spot?
Yes. So
Like, what would
it
you model, like
depends.
vacancy? What would you model for that?
So it depends on what market we're talking about. But let's say it's here in Austin and there's a nail salon, as you say, that's in a space that they've been there, I don't know, 5 or 10 years.
Mhm.
They're probably paying rents in the 20 to $30 a square foot range plus triple nets. Today's market, we're now in the 40s. And so you actually hope that they decide to not decide. Let's just that something doesn't continue on that way. And so
Sure.
you can compare where that rate is compared to what the market is pretty easily. There's a ton of information out there, really
What
easy
are
to
what are
find.
what are what are some resources like websites where people can look at comps and
Yeah, so the top 3 websites I would say is CoStar, LoopNet, which they're affiliated, Crexi, Crexi. So I would go to crexi.com. We use that every single day, and you can see what's on the market right now as we speak. You can narrow it down. You could pick your neighborhood as an example or your city and find, okay, what triple net retail, medical, industrial is on the market right now, and start learning about deals. Download the offering memorandums. Look at 20 to 30 deals before you make an offer. And if you do that, if you're willing to do that work, you're going to learn what you like, what you don't like, and just go from there. Really, the best way, honestly, is to make the investment. That's really the
yeah.
best way to learn is to just to jump in. Working with a syndicator like myself is an easier way to get in at a lower, price point, so you can learn the ins and outs that way. But if you don't want to do that, then I would say building relationships with brokers, saying, "Hey, I'm looking for this type of deal. I have this much money. This is the kind of return I'm looking for. Keep me in mind." And just keep hitting them over and over once a month, saying, "Hey, I'm still out here. You got anything?" And so that's really, you want to stay top of mind, and that's how you get good deals.
Yeah. And then I'll also say that for those that don't have the time or don't want to invest the time, want to work with someone like you, how can they reach out to you? What's the best way to
Sure.
do that?
So, best way to do that, my website, roosterequity.com. We have some information on there. We have a book that I wrote. I haven't released it yet, but I just wrote what is it? Investor guide to passive investing.
Okay.
And we just actually articulated all these different points about how to go about this. Get ready to release it, but haven't yet.
Okay.
And yeah, give me a call. I love to educate. I spend a lot of time teaching. We create educational content, podcasting, all that kind of stuff. Happy to help.
Do you have a link to your book you could send me that I could put in the show notes as well? Or
Yes, roosterequity.com/book.
okay, perfect. Anything else we haven't? I know we could probably talk for 5 hours about a million things, but is there anything else you're like, oh man, I really wish you asked me about this, or really wish you brought this up on the show, or
I think we covered a lot of ground. I'm happy with the conversation, Eric. I'm really grateful for the time and really appreciate your friendship and the opportunity to share this story. And no, I'm pretty content.
great. I appreciate you coming on. And then for those listening, we'll put all the links and relevant information in the notes. And if there's any more questions you have, that is a wealth of knowledge and information. And you can reach out to him on his website. Say it one more time for people.
Roosterequity.com. I'm also active on LinkedIn. And my name
Okay.
is Ben Kogut. Last name is spelled Kogut. Kogut.
All right. Put your LinkedIn profile also in the notes. All right. Appreciate you coming on, Ben. Thank you all for listening. I know it's been a while since I've posted. I've really wanted to revamp this show with extremely high quality guests when I do have guests on. So appreciate y'all listening and hope y'all have a great day. And Ben, pleasure as always, and you're always welcome back.
Thank you, sir.
All right. Stay on.